it's such a big thing to overlook, and it can have ramifications down the track, but it's definitely worth having a conversation and getting advice around this, because something as small as have you got the right product and are you utilising it correctly can have such large ramifications further down the track.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again and back on the podcast.
Andrew, we are back again. And like we say, week in, week out, favourite time of the week, bringing our knowledge and some information to our listeners and our viewers about all things financial advice.
And getting to have a bit of a banter all at the same time.
That's it, Andrew. That's it. Let's get straight into it. What are we talking to everybody about today?
Yeah, so today we're talking about something that I think people kind of don't even know that it's an issue. So we're really going to be comparing and contrasting an offset account and a redraw account. And many people tend to think, at least in my experience, that it's exactly the same thing. There's no difference between them. But there are some differences, and it can be pretty costly if you make the wrong step. So comparing and contrasting offset and redraw accounts.
Yeah, I think the thing to point out as well too is we're not necessarily starting to see, but we're seeing a lot more knowledge and understanding and this appetite around education when it comes to mortgages that we necessarily haven't seen previously. And I think that's because interest rates are higher and obviously people are paying more attention to it because, it's harder to service a mortgage. It's going to take longer to pay it off, all of these things. So trying to increase one's knowledge around what are some of the tools that are available to help pay that off faster. And I think this is a really good starting point in terms of the education piece around, effectively they do the same thing on the surface, but we're going to dig a little bit deeper and talk about the good, the bad, the ugly, and really dig deep in terms of the difference between an offset and a redraw account. So, Andrew, where do we start?
I was going to get a joke in there before, but you were going for too long, so it's gone now. But it was going to be around, back when you were buying houses, the average mortgage price was only $100,000, so people didn't care about offset and redraw accounts then. But
Andrew, for those ones that are watching online, I had a haircut about 3 days ago, so I look even younger now.
Yeah. So what? It's no longer 39; it's now 36.
That's it. Exactly right. Exactly right.
Benjamin Button. So look, I think bringing us back on track after I took us off. I think the easiest way to think about it is, and for those that maybe don't know, an offset account and a redraw account are both utilised, in essence, to reduce the interest that you pay on a mortgage. So let's, for argument's sake, say that you have a mortgage and that mortgage is for $500,000. Let's say you've got $50,000 in the redraw account or in the offset account. The interest that you will pay will be on $450,000, not the $500,000 mortgage. Where maybe, and this is sort of taking it one step further, where maybe people also get a little bit surprised is if you've got money in an offset account or a redraw account, your repayments will still stay the same. So let's say your repayments are $3,500 a month, and let's say, for argument's sake, the interest saving is $500 a month. You're still going to have, your repayments aren't going to drop to $3,500. You're still going to have the same repayments that you did, regardless of whether you had money in the offset account or the redraw account. The only difference is that $500 worth of interest that you're saving is going towards paying down the principal of the loan. So having money in offset and redraw is going to reduce the time frame of your loan. So maybe from a 30-year loan to a 26 or a 27 or whatever it is. But it's not actually going to change your repayments.
So just to add to that, Andrew, using that example, $3,500 is your repayment. When you make a repayment, and this is the same for everybody, regardless of how much money you've got in redraw or offset, unless it's 100% completely offset, but we'll take that off the table for a sec. But in that $3,500 monthly repayment, a percentage of it will be to service the interest and a percentage of it will be principal reduction. So what you're saying and what we're telling people is if there's money in the offset and if there's money in the redraw account, basically the percentage that gets attributed to paying down the principal is larger.
Yep.
And the percentage amount that's going to servicing the interest is lower. But overall, your repayment in this hypothetical example is still $3,500.
Yep, exactly right. Exactly right. So I guess first sort of place to start is sort of what an offset account is. And basically it's just a transaction account that's linked to the mortgage. Now, as we've already said, the balance of that offset account is going to reduce the interest that you pay on the overall mortgage. So repayments will still stay the same. It's just the interest portion is going to go down and the principal portion will also go up. Bill's redraw account?
Yeah, I mean, look, redraw account is no real different in that respect, but using your example before about having $3,500 as your repayment, say this month you decide to make a $4,000 repayment rather than $3,500. $3,500 will go to, like what we were describing before, a percentage will go to servicing the interest, a percentage will go to principal reduction. But in this hypothetical where you've made an extra $500, that $500 will go into the redraw account, which is basically what you've paid above and beyond your contracted repayments to the lender.
Yep.
Most lending products have the ability to withdraw excess so if you've paid excess and you've got money in redraw, you can get your hands on it. That's a really critical point because we're going to talk about that a little bit later. But the truth is there's really no difference. It's internally from the banking perspective, what does that look like?
Yeah.
There's really no difference. On the surface level, there's a huge difference. We'll get into that later on. But no, it's essentially there's not much to it.
Yeah. So reduces the amount of interest that you're paying. Both of them do it. So on the surface, it seems like there's no difference. The only difference that some people might see mechanically is when you've got an offset account, like it's a transactional account, so you've got a card that's associated with it. So what some people do is just dump everything in the offset account and then spend off a transaction account that's linked to the offset. So offset balance is constantly moving up and down. Whereas with a redraw account, most banks, you can't do that because there's no card that's associated with it. So you need to have another account that you're using as your transaction account. Now, it depends on how your banking is set up, your cash flow strategy, all of that stuff, whether one is appropriate versus another, which whole podcast dedicated to that.
I'm going to take us slightly down that path anyway.
But for all intents and purposes, in reducing the interest, they both mechanically work the same way.
Yeah, so just on the interest calculation as well too. So thinking through the contracted repayment per month, in this example, $3,500, the interest paid each and every month out of the $3,500 repayment will change.
Yep.
Simply because you're eating away at the principal, you might have money in offset, you might have money in redraw, but interest is calculated on the closing balance at the end of each day and then added up over the entire month. So one of the strategies that you were talking about and one of the common strategies that people consider is they put all of their income into, say, an offset account and then, heard the strategies where you spend everything on a credit card and then wipe your credit card when it becomes due and payable from your offset account. The reason why people consider that strategy is because it means that you can have more money. Thinking through that interest is calculated daily, you can have more money sitting in that offset account. So that percentage split when your repayment is made between principal reduction and servicing the interest, there's obviously a higher portion towards the principal. And in the short term, it's only minor, but over a long period of time, like compounding interest, it does its thing and it makes a significant difference.
Yeah, absolutely. So now that we know what is similar between an offset account and a redraw account, I think the next point is kind of looking at really what the actual difference is in it and where a lot of people get tripped up. And really it's just around the legal deductibility of an offset account versus a redraw account. Now, to explain the differences, a redraw account is basically like you've put extra money towards the loan. And when you take money out, it's almost like you're taking another loan out. That's the way that I think about it to help understand this mechanically. Whereas an offset account is just a transaction account that sits next to your mortgage and the bank uses that to in essence, reduce the amount of interest that you pay because they're not paying you any interest on that offset account. So really how it works mechanically is, let's use an example of, okay, you've got an investment property, for argument's sake, and you want to take $50,000 out of your offset account, and you want to use that $50,000 to purchase a car. Not for business use, you're a PAYG employee, so there's no deductibility on the car purchase. You're just taking out $50,000 in order to purchase a car. If you take $50,000 out of an offset account and put that towards a non-deductible purchase, that interest or the interest that you're paying on your loan is $50,000 more because you've got $50,000 less in the offset account. And so you've got a tax deduction on the interest that's associated with it. You do the same thing on a redraw account, and that $50,000 is not tax deductible. Now, the reason that it's not tax deductible is if you've taken out a $50,000 loan, or if you've taken out $50,000 out of a redraw account, what you're doing, in essence, is taking a loan of $50,000. So the purpose of the funds will determine whether it's tax deductible or not whether it's sitting on an investment property or not. So because you've used the funds in a redraw account for a non-deductible purpose, it's not for business use, it's not for, anything in gaining an income, that $50,000 is not tax deductible.
We need a whiteboard, Andrew. I'm just thinking there's a whiteboard behind the camera. We should have sat in the other spot.
We should have sat on the other side and ran through it on the whiteboard.
I'm going to use a different example with another strategy that we've got, or that we see that happens quite often. So if you've got maybe a first home buyer as an example, and the first property that they get into is call it an entry-level property.
Yep.
And it doesn't even need to be a first home buyer, but the house that they're in now, at some future point in time, the intention is to convert it to an investment property. So we've spoken on the podcast time and time again about the difference between good debt and bad debt. So debt that is tax deductible versus debt that is non-tax deductible. So on your owner-occupier, the debt that you've got is non-tax deductible. So if you're planning to, and stick with me on this, if you're planning to, at some future point in time, upgrade your house with the intention that you want to convert that property, not sell it, convert it from your owner-occupier to an investment, theoretically, when it becomes an investment property, you want the debt to be as high as you possibly can.
Yep.
Because it increases your deductibility, which helps from an investment return perspective. So in that unique circumstance where that's your strategy, if you're taking additional money and putting it into the offset account versus if you're putting it into the redraw, if you do that for long enough, and let's use the example of you've got a $500,000 loan and you've got $50,000 in the offset account in example A and $50,000 in the redraw account in example B, when you convert that property into an investment, example A, which was the one with the offset, the debt attributed to the investment property is $500,000. In example B, it's $450,000.
Yeah.
So what you're doing in both of these scenarios, while you own the property, you're still getting the benefit of having additional funds in the loan, whether it's offset or redraw. But when it comes time to convert that property across, you think that you've done the right thing, but all of a sudden, in that example that I use, there's a $50,000 difference in terms of
how much of your loan is deductible.
Becomes tax deductible. So that's a really unique set of circumstances that happens. And it takes a lot of discipline to be able to deploy that, because it means if you put money in the offset account, and that's the other thing too, money in the offset account is exactly like a transactional account. It's easy to get your hands on it. In saying that, so is redraw, but it takes a few extra steps in order to do that.
Yeah, you got to transfer it to someone else before you spend it, right? Yeah. So really, an offset account, I mean, if you're faced with a decision and all else has been equal, an offset account is going to give you more flexibility in order to be able to make decisions as and when your circumstances change. But there are times where a redraw account may be perfectly fine. And some people may elect to have a redraw account without an offset account if they know what the intention is for the property. The property is almost definitely not going to change in terms of how it's structured. And there's an interest rate differential. So some banks will say, hey, if there's an offset account, this is the interest rate that we'll offer you, and we'll offer a lower interest rate if there's a redraw account because there's less work that's involved with them. So there can be some instances where you do elect a redraw account, and that's perfectly reasonable. But it is something to be very careful of, because a lot of people utilize a redraw account like it's an offset account. And in essence, if you do get audited and if the ATO comes knocking, there could be a very big please explain here.
It's easy. Yeah, you're absolutely right. It's easy to get tripped up. And using that example that I was talking about before, that becomes even like in terms of the foresight needed to do that. If you're thinking that, okay, I'm going to be in a position where I'm going to convert that across to an investment property, needing to make sure that you've got the financial resources to be able to hang on to that property. I mean, that's a completely different conversation altogether. But yeah, there's a difference between the two. And I think it's like anything, Andrew, that we talk about on the podcast. It's, it's such a big thing to overlook, and it can have ramifications down the track, but it's definitely worth having a conversation and getting advice around this, because something as small as have you got the right product and are you utilizing it correctly can have such large ramifications further down the track.
Yeah, absolutely. Absolutely. I mean, I've unfortunately seen a client where exact same scenario, they have a redraw account, they've got money there, purchased another property and thought, okay, why don't I move money from my redraw account into the offset account of the other property so that I can maximize the tax deductibility for it. And when you figure out, that actually doesn't work that way, and you can't claim a tax deduction, and you might have $50,000 or $100,000 in a redraw account, compound that over the course of a 30-year loan, and the differences are massive, and it's a very, very easy thing to be able to get slipped up on.
One of the other things that I just want to point out as well too, from a strategy perspective, maybe sort of digressing a little bit from the deductibility conversation that we were having, but from a strategy perspective, and I'll use Samantha and I as a perfect example of this, just because I want to rub it into Andrew, but next week we're going on annual leave, and one of the tools that we use to be able to save up for holidays and stuff is having an offset account that we use as essentially our travel bucket. So while we're saving, that does its thing and it offsets the interest that we're paying on our mortgage. We've got multiple offset accounts to do different things. So we've got our main offset account, we've got a travel offset account, we've got a Christmas offset account, and so on and so forth. You can have, if you've got the right product, you can have multiple offset accounts to get that to work the way that you want to do your banking.
Yep.
And that becomes imperative if you've spoken to the team at 360 around the cash flow strategies and things that we do. But a redraw account is only one.
Yep.
So if you've got different piles or buckets of money for different things, essentially it's all in one bucket. You're going to have to keep your own ledger to try and figure out, what's attributed to what. So from that perspective, I really like the flexibility that it offers. Sort of outside of the deductibility conversation per se, it's just a bit more of a creative way to manage your money in terms of how you go about your lifestyle.
Yeah, absolutely. Bills, I think that covers it really well. So thanks for jumping on another podcast. Thanks again to all of our viewers and our listeners for tuning in. If you got some value out of that one, like, subscribe, and feel free to pass it on to family and friends as well.
We'll catch you on the next one. Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.